In this video, we're going to look at Telus Communications, and they're the third largest cell phone carrier in Canada. And what I do in my videos is I run a discounted cash flow model to figure out the stock price. We call that the intrinsic stock price, and we use prior financial information to figure that out. So let's get started with the model. Telus has 28.8 billion in market cap. So that's the value of the company according to the stock market. And they trade at $22.64. So to figure out the value of a company, you take the shares outstanding, we have 1.3 billion, times the stock price, that gives you the market cap. Or you can figure out the shares outstanding, which is what I just did in my model, which is the market cap, 28.8 billion, divided by the stock price, 22.64, equals 1.3 billion shares outstanding. Now to value a company, you have to estimate the future free cash flows. And then you discount those numbers back to today's value. And that's what we're doing in the video today. So let's get their actual free cash flow for the past 4 years. And we could just pull that from Yahoo Finance. Let's get their net income, and that's what we call the profit and loss, and that's on the income statement. And we'll put that into the model. And we'll also get their sales or revenue for 4 years. And my model uses 4 years. Some models use 3 years, 5 years. Let's look at the numbers to see how they move. You can see free cash flow is 300 million, goes up to 900 million, up to 1.2 billion, then drops way down to 33 million. So they must have had a lot of one-time expenses in 2019, because free cash flow is actual cash that leaves the company, but net income uses amortization and depreciation. So that's why the profit and loss climbs each year, but yet free cash flow is kind of all over the place. Revenue is just the sales of the company, and that has been increasing each year, so that's a good sign. Let's figure out the capital structure of the company so we know what to discount the future cash flows by. So the interest they pay on their debt is 690 million, and let's see how much debt they have. We'll go to the balance sheet, we'll go to liabilities section, and the current debt is debt due within 12 months, that's 1.4 billion. Long-term debt is debt due after 12 months, that's 17 billion. And they pay 3.7% interest on the debt. Let's get their tax rate because debt is tax deductible. So the income before tax is 2.2 billion. So they pay 21% in taxes. So the 3.7% interest is deducted by the taxes. So the cost of debt is 2.9%. Now let's get the cost of equity. So we need the beta for that, and that's the volatility of the stock. And the beta is 0.57, so the stock moves about half of what the market moves, which is a good thing for a company. You want to invest in a company that has a low beta because it's not too volatile, which also means the discount rate will be lower. Let's get some more information from the balance sheet. We'll get their current assets. Those are assets which can be converted into cash within 12 months. And that's 4.4 billion. And the current liabilities, which are liabilities due within 12 months, that's 5.6 billion. And the equity, which is the value of the company according to the balance sheet, that's total assets minus total liabilities. And now let's see their operating income, or EBIT. That's 2.9 billion. So now we know their weighted average cost of capital because it's a blend of cost of debt, 2.9%, and cost of equity, 6.7%. 4.3% weighted average cost of capital. That's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. We did a terminal value, which is all years past year 4. We discounted those numbers back to today. And the value of the company is $34 billion. We divide that by 1.3 billion shares. We get an intrinsic stock price of $27. It's trading at $23, so it's a buy according to the model. It's trading at a 16% discount. The stock has been trading in a pretty tight range the past few years. As you can see, it's not volatile, which is why the beta is so low. Let's see what Simply Wall Street values the company at. So they're valuing it a lot higher than I am. They're saying 47 is the intrinsic value. Let's look at the ratios to see how they look. So they're a pretty good PE, 16.5. That's price of stock over earnings per share. I like to see around 15 or below, but 16 is pretty close. And their price of sales is also really good. That's 2.0. That means investors are willing to pay $2 for $1 of sales. I like to see under 2.5 when I invest in a company, so 2.0 is pretty good. The average in the market is 4.2. Price to book is also pretty low, 2.7. That's price of stock over book value per share. They have a weak current ratio, it's under 1, which means that current assets are below their current liabilities. But this could be a timing issue, so you should look at current ratio over a longer time span. ROE is 17%, that's not too bad. I would like to see a little higher. The median ROE for the market is 15%. They have an interest coverage ratio over 4, so they can cover their interest payment, the $687 million, more than 4 times. They have a decent amount of debt, 64%, so they're a bit leveraged. Let's compare them to their competitors. So this is a Canadian company. I'm trying to do more Canadian companies because I do have a lot of Canadians watching my YouTube channel. So of the 4 companies that I consider competitors, 2 are Canadian, Rogers Communications, and the one we're doing right now, Telus. And then the American companies, AT&T and Verizon. It's just the market cap is in the country's dollars, so you can't really compare the market caps. But anyways, Telus has a 16.5 PE, which is pretty close to what everybody else has. The average for these 4 companies is 15. And Telus has about an average price of sales, a little more than average, but they're all pretty good in that category. Their average in price to book amongst the 4 companies. Current ratio, they're all under 1. So that's just maybe how the communications business runs, at a current ratio under 1. Well, maybe it's just a timing thing. ROE, so they're pretty close to average at 17%, the average is 19%. And in debt, the average is 60, they're 64, so they're running about average in debt. And they're the smallest company of the 4. Both Canadian companies are pretty tiny next to the giants of AT&T and Verizon. So Telus looks like a fairly strong company. Let me know what you think about it in the comments. Thanks for watching.